Here's the brutal truth that separates amateurs from professionals. The most profitable trade you'll ever make might be the one you don't take. Jesse Livermore, the legendary speculator who made and lost fortunes equivalent to billions today, discovered this through devastating experience that would reshape how we understand market psychology forever. This isn't some philosophical abstraction, it's a hard-won lesson forged in the fires of spectacular gains and catastrophic losses. Most amateur traders obsess over entries with an almost religious fervor. They spend countless hours hunting perfect setups, analyzing charts until their eyes burn, memorizing every candlestick pattern, and chasing the next big winner that will finally validate their trading prowess. They study indicators, screenshot breakouts, and convince themselves that finding the perfect entry is the holy grail of trading success. Their entire identity becomes wrapped up in being right about market direction, but professionals operate with a fundamentally different mindset. They spend equal time, sometimes more meticulously planning their exits, not just stop losses on individual trades, but strategic withdrawal from entire market campaigns. They understand something that amateurs never grasp. Knowing when to leave the party is infinitely more valuable than knowing when to arrive. A professional asks one critical question every morning. If the market's character changes today, what will I do immediately? Picture this scenario that plays out in markets with clockwork regularity. You're up 40% on your positions over the past few months. The market feels euphoric, almost invincible. Your friends are calling you a genius. Everyone around you is making money. Your portfolio has become your pride and joy, the validation you've been seeking your entire trading career. The financial media broadcasts nothing but optimism. Analysts raise price targets weekly. Your equity curve resembles a staircase to heaven. Then something subtle shifts in the market's behavior, something most people miss entirely. The tape goes quiet during rallies. Pullbacks get heavier. Leaders stop leading with conviction. Volume patterns invert. The amateur sees this temporary weakness and holds tight, convinced that markets always come back. They tell themselves this is just a healthy correction in an ongoing bull market. They might even see it as an opportunity to pyramid positions, to double down on their winning strategy. After all, they're still up 30%, even after recent declines. The professional sees the same price action and recognizes something entirely different. Character change. They start planning their exit immediately, not because they're scared, but because they understand that markets communicate through behavior, not just price. They've learned to read the subtle language of volume patterns, participation rates, and momentum shifts that precede major reversals. Livermore learned this lesson the hardest way possible by losing $100 million in today's money because he ignored his own exit signals during the 1929 crash. This wasn't a novice mistake or moment of panic. This was one of history's greatest traders falling victim to what he later called the invisible trap, the seductive period when profits turn to poison. When success becomes the setup for spectacular failure. The invisible trap is particularly dangerous because it feels so good. Your account balance keeps growing. Your confidence soars. You start believing you've finally cracked the market's code. But underneath this euphoric surface, the market is changing character. The easy money phase is ending. Smart money quietly exits while dumb money pours in. Attracted by recent gains and media hype, the amateur thinks quitting is giving up, a sign of weakness or lack of conviction. They've been taught that successful people never quit, that persistence always pays off. This mindset works in many areas of life, but it's poison in financial markets where being wrong can cost you everything. The professional knows quitting is often the most profitable position you'll never see on your profit and loss statement. They understand that money you don't lose during dangerous periods is money that compounds during profitable periods. Waiting is a position. Cash is a position. No trade can be your best trade of the quarter. When you're emotionally attached to positions, when you start hoping instead of knowing, when you feel anxious about trades that once felt comfortable, these are danger signals that most traders ignore until it's too late. The shift from confident analysis to desperate hope is subtle but deadly. You stop following your rules. You start making exceptions. You convince yourself that this time is different. Consider Mark, a bright engineer turned trader who made 5% weekly during a smooth uptrend. He pyramided on strength with respectable stop losses. Then, breadth thinned and volume flipped down. Days grew louder than up days. His screen time increased, his sleep decreased, and he doubled his size to get back on track. 2 weeks later, he was down 12% and bargaining with the market. He didn't burn out because he lacked skill. He burned out because he lacked a quit rule. Livermore developed a specific, quantifiable rule for recognizing when these psychological danger signals had progressed too far. This wasn't based on gut feelings or market predictions. It was a concrete threshold that removed emotion from the decision entirely. When this threshold was crossed, he would immediately cease all trading activity and withdraw from the market completely, regardless of his opinions about future direction. You're about to learn Livermore's exact rule for knowing when to quit the market entirely. The specific percentage that triggered his complete withdrawal from all trading activity. This rule saved him millions throughout his career and can save your trading account from the invisible trap that destroys most traders' wealth just when they think they've mastered the markets. Amateur traders see small losses as temporary setbacks, minor bruises that require nothing more than patience and determination to heal. They view these drawdowns as chances to double down and recover, opportunities to prove their resilience and validate their trading approach. In their minds, every loss is just a prelude to an even bigger win that will restore their account balance and vindicate their strategy. Professional traders see these same losses through an entirely different lens as critical data points that demand absolute respect and immediate analysis. They understand that losses aren't just numbers on a screen. They're the market's way of communicating that something fundamental has shifted in either their approach or the market environment itself. Jesse Livermore codified this respect into a concrete, non-negotiable rule that saved him millions throughout his legendary career and became the foundation of professional risk management. His rule was stark in its simplicity and terrifying in its implications. If his total trading capital declined by exactly 10% from its recent high, he would immediately liquidate all positions and cease trading entirely. Not 12%, not 15%, certainly not the 20% that most traders consider a normal correction. A hard 10% threshold that triggered complete and immediate market withdrawal, regardless of his personal opinions about market direction or the potential for recovery. Think about that threshold for a moment and let its implications sink in. While most traders are still confidently giving their positions room to work at 10% down, still convinced that their analysis is correct and the market will eventually validate their positions, Livermore was already packing his bags and walking away from the table. This wasn't a decision born from fear, panic, or poor market timing. This was the calculated response of a master speculator who understood something profound about the relationship between capital preservation and long-term success. Here's why this threshold was pure genius from a psychological standpoint. Livermore understood through painful experience that once his capital dipped beyond 10%, his psychology became irreversibly compromised for that particular market cycle. Fear would creep into his decision-making process like a slow poison. The burning desire for revenge trading would begin to overwhelm his normally rational analysis. He would start seeing patterns where none actually existed, driven by desperation rather than the objective tape reading that had made him famous. This psychological transformation is the silent killer of trading accounts, turning a disciplined speculator into a reckless gambler. The 10% rule acted as a circuit breaker against the most dangerous enemy in trading, the trader's own compromised judgment. Beyond this threshold, even the most experienced traders begin making decisions based on hope rather than analysis, emotion rather than evidence. The mathematical reality supporting this rule is equally compelling. A 10% loss requires an 11.1% gain to break even. A 20% loss requires a 25% gain. A 50% loss requires a 100% gain to recover. But the psychological reality is even more devastating than the mathematics suggest. As losses mount, traders typically respond by increasing their position sizes and taking bigger risks in a desperate attempt to recover quickly. This is exactly backwards. They're risking more money precisely when they're demonstrably wrong about market conditions. The deeper the hole, the more irrational the digging becomes. The amateur's instinct when facing mounting losses is always the same. Make it back through increased risk and larger position sizes. They convince themselves that bigger bets will lead to faster recovery. They abandon their risk management rules precisely when those rules are most needed. They start chasing trades that they would never have considered during profitable periods. Their entire approach shifts from methodical analysis to emotional gambling. The professional's instinct operates from the opposite principle: preserve capital for the next high-probability campaign. Livermore understood that protecting his base capital was infinitely more important than any single trade, any individual position, or the seductive illusion of quick recovery. He knew that capital preservation during unfavorable periods was what enabled spectacular gains during favorable periods. Consider Sarah, a systematic trend follower who had generated consistent returns for 18 months. When her diversified portfolio hit exactly 10% drawdown, she faced a critical choice. Her backtests showed that continuing to trade through drawdowns eventually led to recovery. Her emotions urged her to increase position sizes to make back the losses faster. But Livermore's rule demanded complete withdrawal. She chose withdrawal, liquidating all positions and implementing a mandatory cooling-off period. She missed 2 more months of choppy, difficult markets that would have cost her an additional 8% before conditions shifted back to trending environments. When she re-entered using strict confirmation protocols, she captured the next major trend with her full capital intact, ultimately finishing the year up 23% instead of the 3% she would have achieved by grinding through the difficult period. The execution of this rule requires mechanical precision to overcome human psychology. Define your equity peak as the highest end-of-day net liquidation value, not intraday spikes that can create false signals. Track this daily and set platform alerts at the 10% threshold to remove discretion from the decision. When the alert triggers, you flatten everything immediately, no exceptions, no partial reductions, no hedging strategies. The clarity is liberating because it removes the internal debate that leads to further losses. But here's what made Livermore truly exceptional. This 10% rule was just the beginning of his risk management system, not the end. The real challenge wasn't mechanically hitting the stop button when his capital declined by 10%. The real skill lay in reading the subtle market signals that preceded this threshold, the early warning signs that told him danger was approaching long before his capital was seriously impacted. These early warning signals were what separated Livermore from other traders who also used capital-based stops, allowing him to reduce risk proactively rather than reactively. Amateur traders wait for obvious signals before acknowledging that market conditions have changed, dramatic crashes that make headlines, earnings warnings that shock the financial world, or violent reversals that leave no room for interpretation. They need the market to scream its intentions before they'll listen, by which time it's far too late to protect capital effectively. Professional traders operate with an entirely different level of market awareness, reading the market's subtle body language long before it raises its voice. They understand that markets communicate constantly through price action, volume patterns, and participation rates, but these messages are whispered rather than shouted. Jesse Livermore developed an almost supernatural ability to detect these whispers, identifying 3 critical signals that told him when market conditions had shifted from opportunity to trap, from wealth creator to wealth destroyer. The first signal was perhaps the most sophisticated: divergence between price and participation. When stock indices kept rising but fewer individual stocks participated in the advance, Livermore grew deeply suspicious of the market's underlying health. The amateur sees higher prices on major indices and automatically assumes broad-based market strength. They look at headline numbers making new highs and conclude everything is fine. The professional sees the same numbers but examines the market's internal structure, checking how many stocks actually participate versus how many get left behind. This divergence pattern played out with devastating precision in 1929. Throughout the summer, major averages kept hitting new highs month after month, creating euphoria that drew more speculators into the market. But Livermore noticed something troubling beneath this optimistic surface. Only a handful of large, well-known stocks were driving the advance higher. Market breadth was deteriorating steadily while the facade remained beautiful. Instead of thousands of stocks rising together in healthy fashion, just a few dozen leaders carried the entire market on their backs. Here's how to track this practically. Monitor the daily advanced decline line and the percentage of stocks above their 50-day moving average. If the index rises 1% while advanced decline turns negative and stocks above the 50-day slip from 60% to 45% within 2 weeks, Participation is vanishing. Imagine holding 5 positions where 4 moved with the trend last month, but only 1 does this week. Leaders hesitate at prior highs, then roll over on small news. That's breadth fatigue signaling distribution underneath the surface strength. The second signal involved volume patterns that had inverted from normal, healthy behavior. In genuinely strong markets, stocks typically pull back on light volume and resume advances on heavy volume. This pattern makes intuitive sense when stocks decline. Holders don't panic and volume remains modest. But when they advance, buyers step in aggressively and volume expands. But when this fundamental pattern reversed when stocks fell on heavy volume and rallied on light volume, Livermore recognized this as smart money systematically distributing shares to less sophisticated buyers. Think of it like pushing a heavy object uphill. If it rolls back down easily but takes immense effort to budge even slightly upward, the underlying force works against you. Heavy volume on declines indicates urgent selling pressure from informed investors using every rally as an opportunity to reduce exposure. Light volume on rallies shows advances driven by momentum and hope, rather than genuine accumulation by knowledgeable buyers. Volume analysis requires comparing clusters, not isolated sessions. 3 sessions tell more than 1. 5 leaders tell more than a single favorite. Normalize by sector if defensives rally on strong volume while cyclicals sag on weak rebounds. The market shifts toward safety. That's a risk alarm. Watch breakout behavior carefully. Do they clear pivotal points on heavy conviction and hold above on tests? Or do they pop and fade while the tape feels heavy? The third signal was perhaps most personal but equally critical. Livermore's own emotional state and psychological condition. This might sound subjective, but he treated his psychological state as valuable market data, reflecting his unconscious processing of countless subtle market signals. When he found himself hoping instead of knowing, rationalizing poor performance instead of reacting to clear signals, or feeling anxious about positions that previously felt comfortable, these were unmistakable warnings that his edge was disappearing. This psychological signal crept in gradually. A trader might start checking prices more frequently, staying up later analyzing charts, or feeling knots in their stomach when viewing positions. They begin making excuses for poor performance, or convincing themselves that temporary setbacks are normal. Livermore recognized these emotional shifts as early warnings that his judgment was becoming compromised, that he was no longer reading the market clearly. The amateur personalizes every tick and defends every opinion. The professional defends the process. When his mind becomes compromised, he reduces risk immediately, cuts position size, tightens, stops to last confirmed pivots, cancels pyramiding entirely. Waiting becomes a position. Cash becomes inventory. The key insight binding these 3 signals together. They appeared long before his 10% capital threshold was ever hit. They were sophisticated early warning systems allowing gradual risk reduction rather than sudden dramatic losses. 2 signals active meant reduce exposure by half and stop new risk. All 3 active meant flatten to core positions or go completely flat and wait. You can act when down just 3% rather than fighting for survival at larger drawdowns. These signals work together causally. Distribution narrows participation. Heavy selling skews volume patterns, and stress rises as feedback loops intensify. By the time most traders recognize changed conditions, they're already deep in drawdown. Livermore's early warning system allowed retreat in good order, preserving capital for the next favorable opportunity while others remained convinced that temporary weakness was just normal market behavior. The amateur trader feels an almost physical compulsion to always be in the market, terrified they'll miss the next big move while sitting on the sidelines. Every rally without them feels like money stolen from their future. They view cash as dead weight, calculating opportunity costs obsessively, while others seemingly profit from every market twitch. The professional trader understands something fundamentally different. Waiting is a position, often the most profitable position they'll ever hold. After Jesse Livermore stepped away using his withdrawal protocols, he didn't immediately jump back in at the first green candle. He waited with disciplined patience, observed market behavior from safety, and let the market show its hand completely before risking preserved capital. This period of apparent inactivity wasn't idleness, it was active patience requiring more discipline than any trade Livermore ever made. He understood. through devastating experience that forcing trades in uncertain conditions guaranteed further capital erosion. The urge to do something during volatile periods is almost irresistible. But Livermore cultivated the rare discipline to sit on his hands until genuine opportunities became obvious, not imagined. He developed specific protocols to institutionalize this patience, removing emotion from withdrawal decisions entirely. His withdrawal protocol was systematic and non-negotiable. First, complete position, liquidation, zero exposure, not partial hedges or core positions whispering temptation from watch lists. Second, mandatory cooling periods of exactly 3 trading weeks minimum, regardless of apparent opportunities. Third, physical separation from trading platforms, close software, clear desks, remove market apps from phones. Fourth, limited market exposure, 1 brief scan daily maximum, no exceptions for just checking, that leads to impulsive re-entry. Consider Livermore's legendary discipline during the 1920-21 recession. He had triggered his withdrawal protocol in early 1920, when his character change signals flashed red simultaneously. For 18 grueling months, he sat completely in cash, while others attempted to catch falling knives with shrinking position sizes and growing desperation. This wasn't a brief timeout, it was a year and a half of watching markets gyrate wildly without participation. During this extended period, friends mocked him relentlessly for missing rallies that seemed to signal recovery. The financial press questioned whether the great Jesse Livermore had lost his touch, whether his legendary skills had evaporated. Fellow traders whispered he'd become too cautious, missing opportunities that separated great speculators from mediocre ones. The psychological pressure was enormous. Every temporary rally seemed to validate critics and make his caution appear foolish. But Livermore waited with steely resolve, understanding that bear market rallies are designed to separate impatient money from patient money. He knew his withdrawal signals had triggered for valid reasons. Instead of second-guessing his system, he used this time productively studying market history, refining analytical methods, preparing for the next genuine opportunity. He treated his 18-month hiatus as an investment in positioning himself for maximum participation when conditions became favorable. When markets finally bottomed in late 1921 and began showing clear, unmistakable character change, broad participation, healthy volume patterns, sustained momentum, he re-entered with massive positions, reflecting complete confidence in the new trend. The result was some of his most profitable trades ever, generating returns that dwarfed anything achievable by trading through the difficult period. The money he didn't lose became ammunition for extraordinary returns during genuine recovery. This sequence illustrates a profound truth separating amateurs from professionals. Preservation of capital during dangerous periods enables meaningful participation in profitable periods. The amateur sees cash as lost opportunity, dead money earning minimal returns while others profit. They calculate opportunity costs obsessively, torturing themselves with thoughts of profits they might have captured. The professional sees cash as preserved ammunition for the next big battle, understanding that capital preservation during unfavorable conditions allows aggressive deployment during favorable conditions. The discipline required for strategic withdrawal is enormous, perhaps more challenging than active trading. It means accepting you'll miss some moves, that other traders will capture profits while you remain sidelined. It means tolerating profound discomfort of inaction while markets move without you, resisting FOMO that destroys trading careers. But this discipline positions you perfectly for moves that matter most: big, sustained trends, creating lasting wealth rather than temporary paper profits. Strategic withdrawal requires redefining success metrics entirely. Instead of measuring success by constant activity or monthly returns, professionals measure success by capital preservation during difficult periods and maximum participation during favorable periods. They understand trading careers span decades, not months, and that stepping aside during unfavorable conditions enables longevity in a profession, destroying most participants within their first few years. During withdrawal, Livermore developed specific confirmation requirements for re-entry. He needed at least 2 of his original exit signals to reverse convincingly. He required new pivotal points showing confirming action with proper volume expansion. He demanded that his psychological state shift from defensive anxiety to offensive confidence. Most importantly, he started with small test positions rather than full deployment, requiring the market to prove its new character before committing serious capital. But here's what made Livermore's re-entry system truly exceptional. He had developed precise, quantifiable thresholds that removed guesswork from the transition back to active trading. These weren't subjective feelings or hopeful interpretations, they were concrete confirmation protocols that demanded the market prove its worthiness before receiving his capital. You're about to learn these exact re-entry criteria and how Livermore used systematic confirmation to ensure he returned to markets on his terms, not theirs. Knowing when to quit the market is crucial for survival, but knowing when and how to return is equally vital for wealth creation. The amateur trader jumps back in far too soon, chasing the first green candle that appears after a decline, and getting whipsawed by false signals that destroy both confidence and capital. They mistake temporary bounces for genuine character change, confusing hope with analysis and allowing emotions to override systematic judgment. The professional waits patiently for undeniable confirmation through what Jesse Livermore called pivotal points, specific price levels where market behavior definitively proves that conditions have shifted from hostile to favorable. A pivotal point wasn't merely another arbitrary price level drawn on charts by hopeful traders. It represented a critical juncture where market character definitively changed, confirmed by expanding volume, sustained momentum, and broad participation across multiple sectors. These points marked the transition from uncertainty to clarity, from choppy, directionless action to sustained profitable trends that could support significant position sizes. Livermore never argued with the tape or imposed his personal opinions on market behavior. He simply followed the tape's confirmed direction with disciplined precision once pivotal points proved themselves through proper action. You don't argue with the tape, you obey it, or you pay expensive tuition again. His re-entry protocol was systematically designed to eliminate guesswork and emotional decision-making entirely. First, he required at least 2 of his original 3 exit signals to reverse convincingly, not just improve slightly, but demonstrate clear, sustained reversal patterns. If narrow market leadership had triggered his exit, he needed broad participation to return. If inverted volume patterns had warned him away, he needed healthy volume relationships to re-emerge. If his psychology had shifted to defensive anxiety, he needed genuine offensive confidence to return. These weren't subjective interpretations, but objective, measurable criteria that removed discretion from critical decisions. Second, he demanded confirming action from the market itself. The market had to prove its new character through consistent price and volume behavior, not merely through time passage or wishful thinking. This meant sustained moves in the new direction, proper volume expansion during advances, and orderly pullbacks that held key support levels. The market became his teacher, and he remained its disciplined student, never assuming he knew better than the collective wisdom of all participants. Third, his own psychological state had to shift completely from defensive caution to offensive readiness. This internal barometer reflected his unconscious processing of countless subtle market signals. When he felt genuinely excited about opportunities rather than fearful about risks, when analysis flowed naturally rather than feeling forced, when potential positions felt comfortable rather than stressful, these psychological shifts confirmed that market conditions had truly changed and his edge had returned. When these 3 conditions aligned perfectly, Livermore still didn't bet the farm immediately. Instead, he started with carefully sized test positions representing exactly 25% of his normal position size. These test positions served multiple critical purposes. They confirmed his market red, with real money at risk. They allowed him to gauge market response to his entry, and they provided psychological comfort during the transition from cash to active trading. If the market moved in his favor with proper volume expansion and sustained follow-through, he would then systematically pyramid into his position, adding incremental size as the trend strengthened and confirmed itself through continued favorable action. This methodical approach eliminated guesswork through specific, quantifiable requirements that could be measured objectively. He demanded confirmation within precise time windows that varied by trading time frame. 15 to 30 minutes for intraday position entries, 1 to 2 complete sessions for swing position establishment. These windows prevented endless waiting for perfect conditions while ensuring adequate time for genuine confirmation to develop. Volume requirements were equally specific and non-negotiable. Breakout volume had to exceed 120% of the 20-period average, demonstrating genuine interest from significant market participants rather than thin technical moves driven by algorithms or small speculators. This volume threshold separated meaningful breakouts from false signals that trap eager traders seeking quick profits. Price behavior had to meet strict criteria as well. After breaking through pivotal points, price had to hold decisively above these levels on any subsequent pullbacks. A stock that broke above $50 but fell back to $49 on the first test failed his confirmation requirements. Failure to hold above pivotal points indicated weak hands and poor market structure, triggering immediate position liquidation regardless of personal opinions about future direction. Consider how this played out when Livermore identified pivotal points in leading railroad stocks during his 1921 re-entry. When Union Pacific broke above $85 on volume exceeding 150% of normal, held above this level on a 3-day test, and his psychological state shifted to genuine optimism, he initiated his test position. The stock continued higher with proper volume characteristics, so he pyramided systematically as the trend confirmed itself through sustained upward action. No confirmation meant absolutely no participation, regardless of apparent opportunities or pressure from others. Failed confirmation when stocks broke pivotal points but couldn't hold, when volume disappointed, or when his psychology remained defensive meant immediate exit and renewed waiting. This systematic approach required extraordinary discipline but ensured that when he returned to active trading, he did so entirely on the market's terms rather than his own wishful thinking, always with clear edge and controlled risk that positioned him for sustained profitability. You now possess Jesse Livermore's complete system for knowing when to quit the market and when to return. But understanding these principles and implementing them under fire are entirely different skills. The amateur studies systems and fails to follow them when emotions run high. The professional transforms knowledge into automatic responses that override fear and greed. This chapter bridges that gap, converting Livermore's timeless wisdom into your daily operating code. A systematic approach that removes discretion from critical decisions and transforms you from hopeful speculator into disciplined capital custodian. Your identity must shift fundamentally. You are a risk manager first, profit collector second. This isn't just philosophical, it's practical psychology that determines whether you survive long enough to compound wealth or join the majority who lose everything chasing quick gains. The amateur clings to opinions and argues with the tape. The professional obeys predetermined rules and follows confirmed direction. Your job now is institutionalizing this discipline through concrete protocols that function regardless of your emotional state. The cornerstone remains the non-negotiable 10% rule. Mandatory complete exit. When total trading capital declines exactly 10% from its recent high, track your equity peak using end-of-day net liquidation values, not intraday spikes that create false signals. Set platform alerts at 9% to prepare mentally, removing all discretion when the threshold hits. No debates, no hedges, no partial reductions. Flatten everything immediately and walk away. This isn't about fear. It's about recognizing when either your judgment is compromised or market conditions have turned hostile to your methods. Character signals provide early warning before reaching the 10% threshold. Price participation divergence occurs when indices rise but fewer stocks participate. Track this by monitoring advanced decline ratios and the percentage of stocks above their 50-day moving averages. When your index gains 2%, while advanced decline turns negative, and participation drops from 60% to 45% within 2 weeks. Distribution is occurring beneath surface strength. Inverted volume patterns appear when stocks fall on heavy volume but rally on light volume, indicating smart money systematically distributing to uninformed buyers. Monitor this across your entire watch list. If 3 of 5 positions show this pattern simultaneously, broader market character is shifting dangerously. Personal psychological shifts deserve equal weight as market data. When you find yourself checking prices more frequently, staying up later, analyzing charts, feeling anxiety about previously comfortable positions, or rationalizing poor performance, these emotional changes reflect your unconscious processing of subtle market deterioration. Don't dismiss these feelings as weakness. Treat them as valuable intelligence demanding immediate risk reduction. Execute complete position liquidation, not reduction, not hedging, not keeping small core positions. Flatten everything to remove temptation and emotional attachment. Implement mandatory cooling periods of exactly 3 trading weeks minimum, regardless of apparent opportunities. Physical and mental disengagement is crucial. Close trading platforms, remove market apps from phones, clear desks of charts and notebooks. The goal is complete separation from the hypnotic pull of constant price action. Use this time productively through structured routines. Dedicate 90 minutes to historical market study 3 days weekly, focusing on similar market conditions and how they resolved. Spend 1 session weekly refining your trading playbook and extracting lessons from journaled trades. Add physical resets, sleep discipline, exercise, time outdoors to lower cognitive noise and restore mental clarity. Limit market exposure to 1 15-minute observational scan daily. Purely educational, without action items. Absolutely no exceptions exist to this protocol. No just watching that inevitably leads to premature re-entry. No small positions that compromise psychological reset. No monitoring positions you don't own. The discipline required here exceeds anything needed for active trading because inaction feels like lost opportunity when markets move without you. Before considering market re-engagement, at least 2 of your original exit signals must reverse convincingly. If narrow leadership triggered your exit, broad participation must return consistently across multiple sessions. If inverted volume patterns warned you away, healthy volume relationships must re-emerge. If your psychology shifted to defensive anxiety, genuine offensive confidence must return naturally. You should feel excited about opportunities rather than fearful about risks. New pivotal points must show confirming action with volume exceeding 120% of the 20-period average. Price must hold decisively above pivotal points on any pullbacks within confirmation windows. Start with test positions at exactly 25% of normal size to confirm your market. Read with real money at minimal risk. Require confirmation within specific time frames. 15 to 30 minutes for intraday moves. 1 to 2 complete sessions for swing positions. If initial positions move favorably with proper volume and follow-through, pyramid systematically as trends confirm themselves through sustained action. Failed confirmation triggers immediate exit and renewed waiting. If a stock breaks $50 on strong volume but falls back to $49.50 within 2 sessions, the breakout failed. 2 failed confirmations across your watch list within 1 week signals deteriorating market structure requiring renewed withdrawal. Cut losses fast when individual trades go wrong. Never let small losses become large ones through hope or stubbornness. Size positions small enough to survive unexpected moves that destroy over-leveraged accounts overnight. Wait patiently for genuinely high probability opportunities rather than forcing trades in uncertain conditions. Above all, own your process of knowing when to walk away entirely from active trading. Remember Livermore's ultimate lesson: the market will always be there tomorrow, next week, next year. But your capital won't be if you don't protect it systematically when conditions turn hostile. The amateur sees withdrawal as giving up, missing opportunities while others profit. The professional understands that strategic withdrawal often becomes the most profitable position in their portfolio, preserving ammunition for the next genuine opportunity, while others lose money fighting unfavorable conditions. Master this withdrawal system through disciplined practice, and you'll join the exclusive ranks of professionals who understand that sometimes the best trade is no trade at all.